ability to do that. Oh, I already started it. Well, maybe we can go ahead and get started because we're actually a little bit behind schedule already, and we want to leave as much time as possible for questions from you all. So we'll go ahead and get started. Angela, CP, and Pierce, you all set to go forward? All right, sounds good. All right. Well, welcome to the Due Diligence for a Better Investing panel. Really nice to see you all. I know this has been as Devin said, we're kind of coming closer to the end of the 2 days, so appreciate you spending the time with us. My name is Cameron Rudy. I'm the interim managing director at NC3. My pronouns are she, her. The mission of NC3 is to educate, advocate, and activate community capital, which we define as a set of strategies that allows anyone to invest in their community. So really passionate about opportunities that allow non-accredited investors, not just the wealthy, to invest in their communities. And I'm going to go ahead and have each of our panelists introduce themselves and also say something, provide a little short introduction into the way that due diligence plays into the work that you each do. And let's go ahead, Angela, if you wouldn't mind starting, that would be great.
Yeah, happy to start. Angela Barbash, dialing in from my car in Southeast Michigan. I am a co-founder of Revalue. We are a registered investment advisor located in Michigan, and we serve both accredited and non-accredited investors who are excited about values alignment on or off Wall Street. And I'm one of the founding board members for the National Coalition for Community Capital. I'm now on the advisory board, but was there back in the day when that started. So I'm excited to be here and to share what I've learned and to learn from everyone else and what they've learned over the years.
Nice, thank you. Let's see, I'm going to go in alphabetical order. So Pierce, if you wouldn't mind going next.
Yeah, absolutely. Thank you for that, Cameron. Pierce Leonard, SVP, client of Shirley, he, him, I'm pronouns. And as far as Shirley, what we do is we build new insurance products or adapt existing insurance products to niche industries that are underserved or don't have a proper insurance solution. And what we built specifically for the crowdfunding space is a directors and officers liability insurance program. If you're not familiar with directors and officers insurance, it's a policy that protects past, present, future executives, officers of a company from any litigation, because as the executives of a company, they open themselves up to liability. And so we built a very targeted D&O policy built for online capital raising for Reg CF, or companies that are looking into Reg CF, Reg AA+, Reg D 506C. And there's a lot of other bells and whistles that I can talk about, but that's what I do and what I focus on in a nutshell. I've been focusing on helping startups with their insurance from seed stage to IPO and post-IPO or any respective exits for the past 7-8 years. And yeah, nerd out on insurance and crowdfunding. That's my shtick.
Awesome, thank you. Yes, and we're gonna be able to circle back and hear more about that as well. So Tipilton, if you wouldn't mind going next.
Yeah, hello everyone. I'm Tipilton Gomez. I am the head of capital strategies at Honeycomb Credit. Honeycomb Credit is a Reg CF platform that focuses primarily on small business debt offerings. So we're making it possible for everyday people to invest in brick and mortar small businesses. A little bit about pronouns, he, him. And our role, specifically when it comes to due diligence, is really interesting, right? As a platform, we are conducting due diligence on every single issuer that comes and lists themselves on the platform. We're turning away businesses that we don't think are ready. But there's a limit to how much we can communicate that to the broader public. Being a regulated SEC platform, we cannot say like, hey, these are vetted deals, it's going to be perfectly safe. But we oftentimes might have conversations with investors that want to dig in a little bit more into the details. So happy to talk about the due diligence that we do on small businesses, but also how we help retail investors and even more sophisticated institutional investors conduct due diligence on the offerings we list on our platform.
Wonderful. Thank you. So the way that we're going to have this go is that I'm going to ask a few questions to sort of get the conversation started, and then we'll go ahead and turn it over to the rest of you all to ask all of your wonderful questions, because we're in agreement that that is probably the more valuable aspect of this. Yeah. So the first question that I have is for Tipilton, which you've actually kind of started talking about this a little bit, but wanted to dive into a little bit about what the challenges are that come up for businesses and investors with respect to due diligence on a regulation crowdfunding platform, and if you have any tips or tricks to address those or recommendations.
Yeah, so let's talk about business owners first, or founders. First, there's this misconception in crowdfunding, maybe driven by donation and rewards crowdfunding, that most of the time you can just kind of come as you are, you list yourself on a platform, and you can raise funds from anyone, and it's amazing. That might be the case for a lot of donation and rewards-based crowdfunding. But as you start talking to these investment platforms, you might find that you will have to jump through a certain number of hoops. You might have to be providing certain levels of information about your business that you might not have expected at the outset. Each and every platform has their own levels of due diligence, ranging from making sure that you are not fraudulent, being at the most minimal level, all the way to making sure that you are creditworthy or able to take on debt, or pricing your equity at an appropriate price that makes sense for the platform. So you might oftentimes hear that platforms are turning down a large number of issuers that are knocking on the door. Part of that might be that many of these issuers can't provide the information that these platforms require, right? You might not have your articles of incorporation, or you might not have perfectly built financial statements. So preparation in that front is very important. Know that there is a bar that you have to reach before you're able to list yourself on a platform, so that you can understand what that is. And this is all to your benefit, right? We don't want to create a platform where we're listing businesses or offerings that are not high quality and do not meet a certain threshold. On the investor side, it can be really, really hard to know, hey, is this a legit business? Is this a good company? Is this worthy of my investment? And for that's a deeper question, right? Absolutely take a look at the information provided by the company. Take a look at their investment circular, that Form C that you're going to see in every single investment crowdfunding campaign. But that might not be enough. Sometimes, you might not, and the fact that we're opening this up to retail investors means that this is often the case. You might not know how to evaluate a company, in which case you might want to lean on support, or you might want to create your own means of evaluating a company. There's no one right answer for how to evaluate companies on a crowdfunding platform. For example, a lot of my closest friends pick the places that they love to eat at, and that is how to decide where to invest their $100. Do I like the food or not? Some of my other friends, they are thinking about this as, is this going to be a good fit for my portfolio? Am I over-indexed on brick and mortar businesses? Am I under-indexed on real estate? Things like that. So just know that there are resources out there for you, but you might have to create a system, and you might want to reach out to some helpful resources in your area or in your network, or a financial advisor to walk you through that process.
Wonderful. I like that idea of coming up with like your own criteria. You don't necessarily have to use someone else's. Thank you very much for that. Okay, so our next question is, I'm going to have Angela, you answer this one first, and then if anyone else wants to chime in, we can. How do investors need to shift their thinking if they want to focus on BIPOC and women-led businesses? Or maybe any other community that they're interested in investing in that's not maybe the traditional or the go-to.
Thank you. I really love that question because people are asking it, where 10 years ago, people were not asking it. So that is a mark of progress. So I just dropped a link in the chat that I think is a really helpful resource for anyone. This is really targeted, the Due Diligence 2.0 commitment, of which Revalue is a signatory, along with 50 or 60 other firms in the country. It's really targeted at evaluating fund managers who are BIPOC, but the principles could be applied to businesses that are run by BIPOC owners or women owners as well, or really any population that has not had the opportunity, the capital opportunities in the past 40 years that that now exist today. The considerations that are listed there, so a few of them that I will highlight, is using an alternative to a track record. A common criteria in fund management selection is a 10-year track record. And in many cases, these business owners or fund managers have not had the opportunity to have 10-year track records because they couldn't get the capital until people started fund managers in the last 5 years. Another one is to respect the time of BIPOC and women-led businesses, that those individuals, because we, as a BIPOC woman, I can say this and kind of qualified, we on both sides of this, we are in this where we're running in
Angela,
the business or the fund is under capital. Yeah.
Yeah, maybe turn off your video.
Yeah.
We're starting to have some audio issues. I don't want to lose what you're trying to say.
I wondered if that was gonna.
Yeah, it's starting to happen.
I wondered if that was the case. Can you hear me better now? Can you hear me better now?
Yeah, I can. So maybe
Okay.
backtrack just slightly.
Yeah. So, often these businesses are BIPOC or women-led businesses are undercapitalized, and so we're having to do more with less resources, making time a premium. And so, being very efficient with time requests, meeting requests of these business owners, I think is really key. And then the third thing I'll highlight is that the financials may look different. If we're talking about a fund, a community investment fund, the fees, the fee structure of the fund may be higher because it is a smaller fund, or the business costs may be higher as a percentage of the overall expense layout. Maybe the salary to the founder or other costs may be higher because the business is smaller and undercapitalized. As those businesses and those funds get larger, generally those fees start to drop. So not balking about fees and salaries in the first place is very helpful, I think, to women and BIPOC business owners or fund managers. Pilton, I'd love to kick it over to you. Get your 2 cents on this.
Yeah, I think it's a really important question. Number one thing that we've been seeing in the investment crowdfunding space, and specifically in Honeycomb, is that investors are coming to these platforms to diversify where their capital is invested. So they're investing across racial lines, across gender lines. And it's something that we've seen quite a lot of interest in. There are certain things that investors should keep in mind when they are investing in BIPOC businesses, right? First, understand that statistically and historically, there has been fewer opportunities for many of these entrepreneurs to personal guarantee if it's a debt product, or you might not see a lot of big flashy VC names if it's an equity investment, because those networks and that access to those high wealth communities has been shut out. But the other part is making the really cool thing about investment crowdfunding is that one thing that we generally encourage is to view these platforms as places where you diversify your investments. You're not just here to pick the really, really good one. You're here to spread your financial resources across a variety of asset classes, across a variety of entrepreneurs. So taking that mindset, not just thinking about, hey, is this necessarily the right deal? Is this better than that one? But thinking about it more from the perspective of, is this something that I want in my portfolio? Does this meet the goals that I've set for myself in terms of return, as well as social investment goals?
Wonderful. Thanks, Angela and to Pilton for that.
Yeah, and I would just add to that, just looking at the fundamentals, right? The due diligence, the work that has to be done in order to bring these investment opportunities. It doesn't matter if you're Black or white, or if you have other gender profiles that you go by. I firmly believe that, and from my perspective as an insurance provider, I don't necessarily look at what the orientation or what the race or whatever the case may be of the management team. It really comes down to the fundamentals. Did they do the right due diligence, and how can we support them with a meaningful insurance product that they're able to then use to go out to the public and say, hey, you like our business plan, you like what we're doing. If you think we're lie, cheating, or stealing in any way, shape, or form, you can get your principal investment back in the form of an insurance claim. And that's really what, so for and just to kind of chime in on that, I know I want to help championing all of these minorities. And one of my key clients, Boaz Bikes, Emil Nani, he's done it. He's a former, another North Carolinian, and he's been a proud Tiger Mark policyholder, and he uses our symbol of trust and our investor disclosure language on his marketing materials, his websites, and things of that nature. And it really just goes to show that additional level of due diligence that these founders have undergone to have a to sign up and have a D&O policy that protects them, protects the investors, and again just shows that maturity in their investment offering and their business. I'll dovetail into more about that, but just wanted to say that we want to support everybody, right? But at the end of the day, due diligence comes down to due diligence and making sure that people are crossing their T's, dotting their I's, doing all the right things, and being able to coach them. If we see anything that's like, hey, what is this? Why are you, let's, fix this, make this, work with legal, work with CrowdCheck, work with, whomever to get the investment offering and all the due diligence in the best possible way so that they can go out and just build community, build that investor base. And of course, with that, we hope that they're able to succeed with their investment goals.
Yeah, that's great. Maybe that's actually a good segue into the question that I had for you, which was like, maybe you could back up a little bit and talk a little bit more about how, insurance fits with the due diligence, how that, and then also how that benefit or has potential benefit for investors, like how that all works hand in hand.
Yeah, absolutely. So taking a step back, remove crowdfunding from capital raising. Capital raising, if you go to VCs, accredited investors, institutional, in the private company space, if you get a term sheet, right, on that term sheet, it is going to say within 90 days, you need to have directors and officers insurance if you don't already have that. Why is that? It's because it protects the investors. It protects the company's balance sheet so that if they do get sued, instead of having to use the precious investor dollars that they just raised to pay legal fees, defense costs, and things of that nature, they can transfer that to a D&O policy so it protects the investment from those VCs. So, from private to public, if you're going to list on an exchange, if you're going to IPO with NASDAQ, NYSE, or something to that, or any of the public exchanges, there is a requirement to have directors and officers insurance policy in place prior to going live to protect the investors, so that if there's a lawsuit, right, and things of that nature, they can try to hold as much, they can try to protect and maintain as much shareholder value while they, go about handling that claim or that allegation or whatever the case may be. So capital raising in the crowdfunding space, what we've done is built a specific policy that is for crowdfunding companies, so that they can go out there and confidently say that, hey, we are crowdfunding. We may, and we're able to say that we have directors and officers insurance. And what that does is it shows an heightened level of, when it comes to any exit or wind down, if it's M&A, IPO, or bankruptcy, insolvency, or a wind down, you need that D&O in all of those situations. And so it shows that the company is ready to grow and scale and have the insurance and the risk management portfolio and practices in place to be able to do that. And it can check a lot of boxes from an investor's standpoint as well.
Wonderful. Appreciate that. Okay, so now we want to go ahead and open it up to you all. We have a pretty small group here, so I think you can either, ideally, it's great to either write your question in the chat box, or you can just say, I have a question, and we can unmute, you can unmute yourself and ask your question directly, which might be actually the easier thing to do, so that since we're recording this, everybody will be able to hear your question. So go ahead and let us have it. I will give you all a second to ask something.
I'll kick it off. And sorry, I'm kind of formulating this on the fly, so apologies if it's not super clear. What's the minimum level of diligence, I guess, needed for most of the Reg CF, Reg A Plus platforms out there? And I guess what kind of factors go into what level they choose to take part in? Because I know it varies. Some companies or some platforms pride themselves on doing more diligence. Other ones just say they kind of do the minimum. I guess what are the main factors going into that in addition to the minimum legal requirement?
Yeah, as you said, they vary by platform. They can range from, hey, I think WeFunder is implementing this model where you need to have raised $25,000 from your crowd before you're publicly listed on WeFunder and accessible to the broader public, right? Whereas others might be more like, it's really unclear what their due diligence is. That's another interesting point about the Reg CF space, is that many of these platforms cannot explicitly communicate their due diligence to investors just because of the regulations around our space. We don't want to, and FINRA in particular would not want us to promise that, hey, we've run these all through a certain process, so they are okay and vetted and approved. That type of language is scary to certain regulators. But from then on, from like doing the bare minimum, making sure that nothing is fraudulent, that everyone exists, from then on, the range of diligence can really vary. On Honeycomb, we are taking a look at personal credit scores. We have a credit score cutoff, where if a business is below a 650, they probably will not be able to raise funds on Honeycomb. As well as we're taking a look at the debt service coverage ratio of their loan. And we are also going one step further in terms of the fact that we price the offerings according to risk. Whereas on other platforms, a business might price themselves or set their own valuation, and so there could be many ways for due diligence to not play a major role in these things, and it's very much like buyer beware. But you really have to look at each and every individual deal before making a decision. You have to take a look at the investment offerings.
Yeah, I would add that some of the nuances, I guess, in the amount of due diligence and the amount of information that you'll see on SEC or the investment landing page really does deals with, is it a company that is just starting out, no operating history? They are just now raising because of an idea, a passion, things of that nature. The due diligence on those type of projects, right, are going to be less because, or at least in my opinion, and all I do is look at SEC filings all day. They're much more simple. They're much more straightforward. There's not a lot of history to look at versus a company that has been in operations for, multiple years. They may have raised angel or VC or other capital in the past, and their filings, their financial statements, their due diligence as far as past raises, the allocation of voting rights, the allocation of can the securities be modified, and how the allocation of the offering plays into the entirety of that company's cap table, right? The more sophisticated, the more downstream, or I guess more the longer the company's been in business, I guess I should say, should really, you'll see a huge difference between the amount of due diligence, the amount of information provided, and things of that nature. So yeah, that's kind of the quick way to that I see a big difference in not only the due diligence information that's being provided, but why is there a difference in due diligence information being provided between different companies based on where they are and their, in their cycle, start, seed stage, or growth stage, whatever the case may be. Hopefully that's helpful. I'm happy to continue talking, but I'm known for blabbing, so.
Me too. So I appreciate it. That's very helpful, both of you. Thank you.
Absolutely.
Angela, did you have anything you wanted to add to that?
No, I think they both did a great job.
Okay, great. And then I also want to, John, feel free to decline this since you're not, you have no prior warning on this, but John, I met you yesterday and you are working with a newer platform. Is there anything that you wanted to add to that question since you're here?
Yeah, thanks for bringing it up, Cameron. I think it was, excuse me, it was covered pretty well. So I'm not sure I have much to add, just for everybody else on the call. So my name is John Elias. I'm the CEO and co-founder of a new regulation crowdfunding portal. We just had a soft launch of the website about a month ago. It's called the Impact Crowd. And so that's kind of where Cameron was coming from on that too. So, but yeah, I think in terms of what's already been said, there's some say, regulatory required due diligence, but then there's also the spectrum of due diligence. So I think that's also something we're trying to see how much of that we can provide as well to investors.
Wonderful. Thank you. Sorry to put you on the spot there.
No, it's okay.
Would anyone else like to come with the question? If not, I have some others, but want to hear from you all first.
Can you see? I don't know if you can see me, but I'm raising my hand.
Oh, yeah. Sorry, I did not see. Yeah, I meant to mention that I'm very terrible at seeing the emoji hand raised. I did not see your hands, but you can go ahead, Rebecca. Please do.
Okay, I have a question, and it can be to the full group here because it's not, I'm not sure if it's like directly relevant to anyone on the panel since Honeycomb does debt offerings, but I'm just curious, it's come up a number of times, this challenge around valuations for equity raises. And I'm just wondering if anyone has ideas of best practices for supporting investors who want to do equity investments and have to deal with like just how challenging it is to have any sense of if these valuations are good. Curious your thoughts.
Yeah, Honeycomb has done a number of equity campaigns as well. And the way that we have kind of tiptoed into the equity space was being very clear, like we have no idea how to value companies. So what we do is we lean on the expertise of an existing investor who has invested a significant amount in that company already. So when we're talking to founders, we say, do you have an existing term sheet Has someone valued you already? That's kind of our gate running campaign on the platform. I think that might vary by platform to platform though.
What then are you able to share with investors about that process?
About the
know you
process of
mentioned-
how we got to evaluation.
Yeah, like, are you
yeah.
able to say we got this evaluation through working with a large investor, or is that regulated?
That I don't think we're able to mention that specifically. But we are able to say, you know, we came to this valuation. If you have more questions about it, you can ask the entrepreneur. And all that's stated in the offering docs. So what ends up happening is that when an investor has deeper questions than what is seen on the campaign page, they might reach out to the business owner and, you know, ask certain things about financials or valuation. Yeah, big dance we're doing where we cannot share too much about, you know, our decision-making process.
Right. Yeah. That's I would piggyback on that. It's more of an art than a science. I think the valuation side of things, right? I think at the end of the day, when you're looking at the company's offering and the value, and if they do post a valuation, I know some groups have pulled back from providing a firm valuation on their investment page, but it's really it's understanding their forecasting company growth from a revenue perspective, margin perspective, if there's any patterns or debt to equity ratio, and then just really looking at the geographic areas, or just the market that they're in, the industry that they're in, and understanding if it's a stable market or a volatile market, and understanding if the industry that they're in is, in a growth industry that like impact investing, ESG, BIPOC, right? All of these newer emergences, right? They're on a growth projection where there's other industries that may be facing, challenges in a growth perspective. So there's no perfect way to justify any valuation. I will say that in the past, I thought that there was a lot of valuations that were overvalued. So I would, in my conservative insurance risk management lens, I would say a more in my opinion, is more appealing from an investor standpoint, but also a risk standpoint, because that shows that there's growth versus that a company that's raising 5 million with a 300 million valuation. It's like, why am I jumping on this company when their valuation is it just doesn't make sense. So I think a lot of it does come down to common sense and just kind of reviewing and backing into like, does this make sense or not? But yeah, there's no perfect answer for you so apologies that couldn't provide a silver bullet.
Angela, you have any thoughts on this one?
Sure, and I'll shut my camera off for this. The couple of things that I wanted to touch on this one, Pilton and Pierce sort of covered as well. I'll just reiterate that valuations are often set by prior investors if they've raised capital in a seed round or a Series A before they've gone to the crowd, so to speak. And the profile of those prior investors can really set the tone. There are impact investment funds out there that are willing to pay more because they are, they're pricing in the impact of the impact opportunities of the company. And so if you are an impact investor, then that may make sense to you. But if you're not an impact investor, that may be a deal killer for you right there because the valuation is it's just too high. And so I think the tone really does get set before those folks tend to walk in the door and you see them in the first place. And then secondly, to what Pilson said, there's the valuations are just all over the place, and the rationale for them and the methodology for them is wildly different, even within the sector, that segment, that stage of business within that sector. There still can be a pretty wild range of what is deemed acceptable. So I think, I would tell any investor to do what makes sense to you, right? To agree to it, the terms, if it makes sense to you, and not worry too much about whether, it's overvalued or undervalued. Well, I don't think you'd worry about undervalue, but overvalued.
Thank you. Right. Good question so far. Any more? It's your opportunity. We got about 5 minutes. Sorry, did somebody start talking?
Oh yeah, I was going to say, Cameron, maybe I have one question. It's probably adding on what's already been said, but if we think about from, say, pitfalls related to this, it sounds like valuation can be one pitfall in terms of, what could go wrong for investors here. Has anybody else observed other issues that turned out to be a problem for investors related to these offerings, or maybe a missed due diligence, or any other challenges that came up?
Oh man, that's a good question. I would say one of the biggest things that I look for when underwriting companies is if it's especially for those that are doing a secondary crowdfunding offering, are the executive teams selling stock? Are they selling to, they're selling off their ownership a little bit within the crowdfunding, and they are of course taking the proceeds from that as a cash out, so to speak. So that's, I would say, probably one of the biggest things that I look for when underwriting all the offering due diligence, and making sure that, again, the alignment between, making sure that are trying to understand and interpret if from all the due diligence, if the interests are aligned from the investor perspective, from the company raising capital perspective, and making sure that it's, just everyone's, it's marching forward, and there's no conflicts of interest, or conflicts of the result of the crowdfunding campaign. If I'm raising $10 million, I raise 10 million and I get paid 1.5 million of it because I sold $1.5 million of my shares in that. Granted, I'm still working for the company and trying to build it, but that's a little premature of a payout, in my opinion. So that's something that always raises a red flag for me when looking at due diligence.
That's really helpful insight. DP, do you have anything that you want to add on that one?
No, yeah, that's a great point, Pierce. I think there were some pretty big campaigns that, ended up paying out some of the founders, and that was pretty concerning to see.
Yeah.
So always, read the offering circular, make sure you can really dig your teeth into what is being bought here, right?
Mm-hmm. Yeah, and yeah, just to add to that, I would say looking at the allocation of the offering compared to the rest of the cap table, and always looking at if there's any reason that there's the securities could have a modification to voting rights or things of that nature. I know that a lot kind of give proxy to the CEO or the lead investor, but voting rights and modification rights of the securities are other two points that I drill down on when reviewing offerings.
Angela, is there anything else you want to add to that question?
The thing that came to mind for me was a gauge of social capital that you could evaluate a business on paper all day long. You can read all their documentation and not catch that they have a blemished reputation in their community unless you went and looked at their Google reviews or their Facebook reviews or just did some simple searches for them. So it's an often overlooked method of gauging what's going on with a company within their own backyard. And so I would add that to the list of things to do when you're checking in on a company.
Wonderful. I like that. That's
Yeah.
great. We have 35 seconds. So thank you so much for spending a little bit of your day with us. And I want to extend my thank you to Angela, Pilton, and Pierce for agreeing to be on this panel. I think this has got a lot of really good questions and answers. And I hope you all enjoy the rest of the conference. It's nice to see you all. And we are going to get kicked out of here in about 10 seconds. So I'm going to stop recording, and hopefully those who are watching this also enjoyed this panel. So.
Thank you, Cameron. Yep.